Welcome to the latest episode of Quest for Twice. Today is February 16th, 2022. In this episode, I'm going to cover two earning updates and then do a deep dive on Equifax. So first, earning updates from JFROG. So this graph shows JFROG annual revenue growth from 2019 to estimated 2022. So we can see that the revenue growth is pretty nice, over 30%. The forecasted 2022 revenue growth is less than the growth in the last 2 years. So we'll see what happens, see if that is conservatism in estimates or there is any underlying reason. If we look at the revenue growth in the last 10 plus quarters, then we can see that the growth is very steady and not much seasonal variations. On the financial side, since JFrog is a software company, so it enjoys the high gross margin. Even with the 33% forecasted revenue growth in 2022, its 3-year revenue CAGR is still 35%, so that is very high. In the latest quarter, the net dollar retention rate is 130%. So that's another growth driver in its revenue because it's getting paid more from each existing customer. Duration to parity is 8 years. So for a software company, that is not bad. And in 2021, it spent almost $200 million on mergers and acquisitions. That is why if the 2022 revenue growth is decelerating, it will be disappointing because I would expect the mergers and acquisitions in last year will contribute to revenue in this year significantly. So kind of fast growth continue. I covered this slide before, so I just need to do a quick update here. So in the Q4 2021, and if we look at the Enterprise Plus revenue, it almost doubled, grew by 100% year on year. So the other products revenue also grow, but just not as quickly. So really, the future of JFrog business success depends on the adoption of its Enterprise Plus offering. So far, the trend is good, but only time will tell. INMD is also growing its revenue very nicely. So on the left-hand side, the bar graph shows the annual revenue for the last 6 years. Although 2020 grew nicely from 2019, it's actually a below trend growth because of the pandemic. And the revenue in 2021 just exploded upwards. As a result, its CAGR is about 50%. That's extremely fast growth. For the outlook, the 2022 sales is expected to come in around $420 million. That's an 18% year-on-year increase. The management tends to be very conservative when they give outlooks. So I believe that number will be exceeded by the actual. If we look at the revenue growth on a quarterly basis, we can see that the Q2 2020 had a revenue reduction because of the shutdown due to the pandemic. And we also see some effect in Q1 2021. That's also because of the COVID wave in the winter last year before the population was widely vaccinated. But we don't see has a pronounced effect on revenue from the Delta and the Omicron waves. But there is no doubt they do suppress revenue somewhat. Therefore, if we can put the COVID back into an endemic in 2022, I believe the revenue growth will be unsuppressed in this year and really enjoy very high growth. So I showed these two graphs before. Here is an update. On the left, it's a trailing 12-month revenue versus the stock price. So the bars show the revenue growth nicely in the last 2 years. And there was a big price run up, then plummet in last year and lasted into January of 2022. And if we look at the price over sales, now the price over sales is about 10. That has almost reverted back to the pre-pandemic level, and also almost reverted back to the level that's before the vaccine was widely available. So I would say the current valuation level is much more reasonable. Duration to parity is 5.8 years. Considering the very high growth rate, that is a steal. And even we only use the traditional valuation metric of price over earning, and the current level is about 23. For a high growth company, that is cheap. Now I'm going to switch gear and talk about a deep dive on Equifax. Equifax is commonly known as one of the credit bureaus that keeping the credit reports on consumers. But it actually does a lot more than that. It's a cloud-native financial service provider that helps businesses, agencies, and consumers make critical decisions using its data. Its 2021 revenue was about $4.9 billion. It has 3 segments. One is called Workforce Solution. That's its largest with 41% of the revenue. And the U.S. Information Service, 36%. And the international segment, about 23% of revenue. Workforce Solutions, what does it do? It provides data related to income and job history, education history, criminal justice history, and those data can be used for various purposes. We can see on this pie chart that 40% of the segment revenue comes from mortgage market, and the government and the consumer each is about 12%. Unemployment benefit, that's about 11%. The remainder 19% were from the talent solutions and also other employer services. So why do those verticals need Equifax data? Because a lot of those involve verification requirements. So Equifax has the consumer history data to verify an individual in terms of their income and job history, education, and criminal records, so on and so forth. USIS is the traditional credit bureau business because it has the credit files. However, it also has alternative data like utility payments and e-commerce transaction information. This type of data traditionally is used to make consumer credits, including mortgage, personal loans, and auto loans. So that's 70% of the segment revenue. But it's also used for other purposes. For example, commercial risks for small businesses, and also for marketing purpose to identify the right people to send the marketing material to, as well as identity and fraud service. It's an international segment is operating as 4 regions, including Asia Pacific, the largest, and Europe, Canada, and Latin America. I would say those markets are still in the early innings of a credit files and income job history data digitization journey. So they should have a lot of growth ahead. This slide tells the Equifax growth story. So let's start from the top right. The gray bars shows the revenue since 2015. The CAGR is about 9%. On this same graph, I also plotted the EBITDA margin. Historically, the EBITDA margin was over 30%, but it took a big dip in 2018, 19, and 20. Only recently recovered back to above 30%. So I will talk about it more later. But here I will focus on the revenue growth. So what drove the revenue growth? So that's explained by the bottom right. Because of mortgage market is a very big consumer of Equifax data. So the bottom right figure separated the mortgage market impact on the overall revenue growth. The purple bars were the overall mortgage market growth from previous year. So we can see that in 2020, for example, the mortgage market demand grew by 9%, and 2021 it reduced by 3%. And Equifax now is forecasting a further 7% reduction in 2022 in terms of mortgage market demand. Despite the mortgage market fluctuations, the green bars shows the underlying business growth, taking out of the impact from the mortgage market. So we can see that in 2021, there was a huge core market growth for 22%. And that's more than offset the 3% mortgage market demand reduction of 3%, and delivered 19% revenue growth year on year. And similarly, despite the forecasted 7% mortgage market contraction in 2022, Equifax still sees the revenue will grow by 8%, driven by the 16% core business growth. So one may wonder why we see a big ramp up of core revenue growth in 2021 and beyond, comparing to 5% in 2020 and to 3% in 2018-2019. That can be explained by the segment growth within the Equifax. So that's shown on the bottom left figure. So in the year 2020, 78% of the revenue growth was driven by the workforce solution segment. That's the blue color. And in year 2021, similarly, 75% of the growth was coming from the workforce solution. And going forward, Equifax is forecasting about 60% of the growth will come from the workforce solutions. Now let's look at the margin story. There was a significant data breach in 2017. Hackers stole a lot of Equifax data due to its security lacks. So as a result, Equifax spent a lot of money to pay for any damages as well as upgrade its system. So it went on a cloud transformation journey since 2018 to achieve better security and also to build a single data fabric inside the Google Cloud. That's why if we look at the top right, the gray bars are the reported the EBITDA margin. But if we add back the actual cost related to the data breach as well as the cloud transformation cost, then we can see the adjusted EBITDA in those 3 years are back above 30%. And 2021 actually was above 35%, and that's at a historically very high level, and with forecasted growth in 2022 as well. The main reason is if we look at the cloud transformation cost that's shown below the top right figure, we can see the heavy spending was in 2018, 2019, and 2020. Now the cloud transformation is almost over, and the cost will become negligible going forward. And similarly, if we look at the capex investment as a percentage of revenue, the platform and transformation cost in the bottom right figure was a significant portion pre-2017 and in 2020 and 2021. Then it's going to gradually taper off. And the red bar is the capex spending on the product, which Equifax can actually monetize. So it was low in the past compared to the investment in platform and transformation, but it has gradually ramped up and will be much higher in 2022 and forward. As a result, I conclude the Equifax is poised to growth revenue and margin, and as shown in the graph at the bottom left. Equifax is forecasting a 8 to 12% CAGR revenue growth going forward. And at the bottom of this graph, it also shows the EBITDA margin is going to expand going forward. So as a result, its profit will grow significantly faster compared to its revenue. So what are the growth drivers? The first one is cloud. Equifax has migrated its data to a single data fabric with high reliability that enables it to provide products very efficiently and fast to its customers, and will be able to better monetize its existing data. Number two is, as I mentioned earlier, it's spending more on new products and innovations, as shown on those two figures on top. Top left shows the number of new products launched in the last number of years. We can see that it's getting more and more each year. And also, Equifax reports a vitality index. That's the 3-year rolling revenue of the new products as the percentage of its overall revenue. And that has been increasing from 5.2% in 2020 to about 9% in 2021. And going forward, Equifax is forecasting that will be over 10%. The third growth driver is its workforce solutions. So we can see that at the bottom right, that will drive the revenue growth by about 5% going forward, and with the other segments also contributing to growth. The last one is mergers and acquisitions. So in the last several years, Equifax has spent $1.5 billion for the cloud transformation, but it also spent over $3.5 billion on mergers and acquisitions. That expands its product offering and will drive its revenue going forward. So what's my investment thesis? At the current valuation, its EV over EBITDA is about 16.8, and its EBITDA growth is going to be over 12% going forward. As a result, the EV over EBITDA ratio is fairly reasonable. And even better, it has a very wide moat, and that's growing even wider with more data. It's not really possible for any new companies to get into the credit file business, so there are only 3 of them currently. However, Equifax built a commanding lead in its workforce solution with workforce-related data. It'll be very hard for the other 2 credit bureaus to start from almost scratch to build a significant business as the Equifax workforce solution. And even better, as a leading data provider, Equifax can extract more value from additional data than its peers. So if a standalone company has data, Equifax can outbid the others to acquire that company's data because it's a large database, and any additional data will be more valuable to Equifax's customers than if the data is standing alone, or if the data is going to its competitors with a much smaller database. So my investment thesis is to buy a very high quality growth company at a reasonable price. So what are the threats and opportunities? The near-term threat is the mortgage market. That's about 20% of Equifax revenue. That'll contract in 2022 due to rising interest rates. On the other hand, economy recovery will lead to more lending and demand for Equifax data, as well as more hiring. That will also lead to more demand for Equifax data. If we say chips are the heart of the modern digital economy, then data is its blood, and Equifax has a lot of it. So that will be a long-term secular tailwind. As an added bonus, Equifax's heavy infrastructure investment is winding down, so more cash will be available for buyback and dividend. Since it has a wide moat to begin with, and it's getting even wider, so the only real threat I see to its long-term business is itself. Specifically, there are risks related to data security and privacy and data accuracy. And those could lead to regulatory interventions and curb the influence of Equifax and its future revenue growth. But putting everything together, I would say Equifax has a bright future ahead of it. It's currently selling at a very reasonable price. So this concludes this episode of Quest for Twice. Until next time, happy investing.